We have all heard the script. It gets handed down from our parents and repeated by every real estate agent on a bus bench. Buying a house is the ultimate marker of adulthood and the guaranteed ticket to middle-class wealth. And if you don't buy, the script says you are throwing money away, paying a landlord's mortgage instead of your own, and failing to build a financial future. So millions of people panic and rush to sign documents they barely understand, stretching their debt-to-income ratios to get a foot in the door. Today, that door is incredibly heavy. With 30-year fixed mortgage rates hovering around 6.5% and the median home price sitting near $420,000, the math has shifted, which forces a question we are rarely allowed to ask. Is renting actually throwing money away, or is it a strategic wealth-building choice in the modern economy? To find the truth, we have to strip away the emotional shame and look strictly at the math.
Specifically, we need to examine what economists call unrecoverable costs. When you rent, your monthly payment is unrecoverable. But when you buy, your unrecoverable costs are the interest, the property taxes, and the maintenance. Both sides have money that disappears forever. The choice you face is not between building wealth and wasting money. You are choosing between two entirely different, mathematically valid wealth-building strategies. The most persistent myth in real estate is that your entire monthly mortgage payment goes straight into a savings account called home equity. Look at this amortization schedule for a standard 30-year loan. Notice how small the green sliver is compared to the massive red column. In the first 5 to 7 years of owning a home, 70 to 80% of your payment goes straight to the bank as interest. It builds zero equity for you. You are not escaping rent. You are trading renting a property from a landlord for renting capital from a bank. Then come the perpetual fees you pay to the government for the privilege of staying on your own land, property taxes, and homeowners insurance, neither of which yield any residual return. Next is the hidden burden of maintenance. Standard financial models dictate you will spend 1 to 2% of the home's total value on upkeep every single year. These aren't fun renovations. This is fixing a leaking roof or replacing a dead water heater. Stack the interest, taxes, insurance, and maintenance together, and you get a towering column of cash that vanishes completely. Homeowners throw away thousands of dollars a year. Once you factor in those expenses, the argument that renting is the only way to waste money completely falls apart. To figure out which column of disappearing cash is smaller, you need a way to compare renting and buying apples to apples without building a complex spreadsheet. Financial planner Ben Felix created a framework for this called the 5% rule. You take the total purchase price of the home you want, multiply it by 5%, and divide by 12. The result is your break-even monthly rent. That 5% accounts for roughly 1% in property taxes, 1% in maintenance, and 3% in the opportunity cost of tying up your capital. If you can find a comparable rental for less than that break-even number, renting is mathematically superior. If you want to evaluate an entire city or zip code at a glance, you can use a macroeconomic metric called the price-to-rent ratio. You calculate this by dividing the median home price by the median annual rent. A ratio below 15 suggests that buying is optimal. But once that ratio climbs above 20, the math heavily favors renting. In highly inflated markets, renting functions like a financial short on local real estate. You get to consume expensive shelter for a fraction of its capitalized cost, letting the landlords subsidize your lifestyle while they absorb the market risk. The biggest hidden cost of buying is the massive pile of cash required upfront to get the keys, your down payment, and closing costs. This creates an immediate opportunity cost. By committing tens of thousands of dollars to a single property, you sacrifice the historical 7% compound annual growth that capital could have earned in the stock market. Instead of tying that money into a house, you can execute a rent and invest the different strategy, where you take that potential down payment and monthly savings and put it directly into a diversified index fund. This chart from Zillow illustrates exactly how that plays out. We are looking at the after-tax investment balance of a renter, represented by the purple line, plotted against the liquid equity of an owner over a 16-year timeline. Depending on local housing appreciation and the performance of equities, a disciplined renter's net worth can completely outpace a homeowner's over long stretches of time. The second major threat to a homeowner's wealth is the cost of moving. Selling a home is incredibly expensive. Agent commissions and closing costs routinely eat up 5 to 10% of the property's total value. If you buy a house and receive a new job offer in another city 3 years later, those transaction fees will instantly obliterate whatever tiny fraction of equity you managed to build. If your life requires you to move within 5 to 7 years, renting isn't throwing money away. It is the strategic purchase of career mobility and flexibility. National averages are useless when making a highly personal housing decision. You have to map these mathematical realities to your specific lifestyle and zip code. Let's place this on a matrix. On the bottom axis, we have your timeline, mobile versus stable. On the side axis, we have your local market, low price to rent ratio versus high. The optimal buyer profile lives down here. You plan to stay put for 7 to 10 years, you live in an area with a low price to rent ratio, and you value the psychological stability of putting down roots. The optimal renter profile lives up here. You live in an expensive coastal market, you want the freedom to chase career opportunities, and you prefer liquid assets over concrete ones. But there is a massive behavioral trapdoor waiting for the renter. The entire mathematical advantage of renting completely disintegrates if you take your monthly housing savings and spend it on lifestyle creep. For renting to win, you have to answer this question honestly. Will you actually invest the difference every single month? A 30-year mortgage is essentially a powerful, forced savings account for people who lack the discipline to invest manually. Renting serves the disciplined optimizer. Neither path is inherently superior. They are simply different financial vehicles carrying distinct risk profiles. You do not have to internalize the cultural shame of being a forever renter if the math and your need for personal freedom dictate that it's the smarter choice. A house is a consumption choice and a place to live. It is not a guaranteed ticket to wealth. Run the numbers for your zip code, get honest about your timeline, and make the choice that actually serves your life.